Hello ladies and gentlemen, thank you for joining Ascending Abundance YouTube channel. My name is Pavel Sverdlin, and on this channel I cover various strategies on how to make money with the existing capital. We got stocks, real estate, crypto, business, anything that comes. I want to make a lot of money as opposed to saving and thrifting a little bit. So far being a chartered financial analyst and certified public accountant, I know a lot, I have progressed a lot, but I'm still looking into it and still learning as I go for decades if I have to. So today's video is about Enbridge. This is my own financial kind of analysis. It's not advice. I'm not a planner. I'm not an advisor. Please do your own research. Hopefully you will see this valuable. So Enbridge, I owned it for over a decade. I kind of like the company. They always have this nice narrative about paying good dividends. Their pipeline, they're regulated by government. They almost always make money, return on equity, because the government guarantees them the pass-through of oil and natural gas. Also, they're not selling oil or natural gas, they're just passing it through, pumping it. So, the transportation does not depend on price. You obviously have a much more stable kind of business model. All that is good. However, if I look at the price of Enbridge, this wonderful darling did give us, a double over the 10 years, according to this chart, from 2013 to 2023. It's 100% return. Okay, kind of not bad, not phenomenal either. But if I compare it to the Canadian market, which is XIU, Enbridge is lagging. If I compare this to S&P 500, Enbridge is obviously lagging. And if I compare this to Nasdaq, then Enbridge is nowhere to be even seen on this graph. So I am certainly disappointed in the performance of the stock, but at the same time, there is a place for more conservative part of the portfolio, a dividend-focused piece of investment. So kind of on the sidelines, but then there's been this 5-year streak where they haven't returned a single percent. Now they kind of went up and now it go trending again down. So what is happening with Enbridge? I have looked at their financial statements, so super easy. I'm gonna pull it from the other screen. You go Enbridge Investor Relations. This type of website comes up. Click on the investors, and then in here says reports and SEC filings, quarterly and annual reports right here. View page, and then you select the annual reports. Quarterly, annual, doesn't matter. Look at the latest and kind of go do the analysis. This type of PDF comes up. I know not a lot of people enjoy reading financial statements, so I kind of do. Again, CFA, CPA, this comes easy to me. I just kind of click here on the financial statements and supplementary data, goes through the disclaimer, disclosures, whatnot, and here's the information. I put it in my own way. I put it in Excel. Lots of info here, kind of bear with me. I'll walk you through. So this is their income statement. All I look at is sales and net income, and I typically don't go back as far as like 10, 12, 15 years. This is crazy. I'm only showing this because I used to track this for years and I just have the data, so I just kind of happen to have all this information. So let's look. Sales, net income. That's all I care about. Their profit margin. Are they profitable? How much money are they making? And they've been kind of consistently up and down, but about 5 to 6% rate of profit margin, not rate of return. Profit margin, nothing wonderful, but that's their business model. Some of the companies make money on volume as opposed to on high margin, like Apple or Microsoft. So sales are growing. You could kind of see there's a bit of a bump and then a slump and then it went back up. I'm guessing COVID had something to do with it. That's okay. They're progressing. They're making more money. Not phenomenally so. Their growth rate is kind of but it happens. Net income for pipeline company is just like real estate. They write off a lot of depreciation. They invest a lot in their pipeline assets. So net income is not really the good indication of their financial stability. Cash flow would be something I'm going to look at in a second. That is way more predictive of their ability to pay their dividend, to increase their dividend, and grow in price as a result. Let's look quickly at their assets. So assets are clearly growing, right? And they've grown by heaps and bounds. There's this jump from 2016 to 2017. They acquired somebody. They keep on buying their competition. They keep on building more assets. The goodwill, which I don't like, is there, and it is something they typically overpay by acquisition. So that's a dollar that was spent above and beyond any kind of identifiable asset, trademark, intangible asset, software, anything that you can possibly identify when you're buying a competitor. Anything paid above that is called goodwill. It's a bogus asset. It makes no sense to keep it on the balance sheet, in my opinion. It's not producing you anything. You paid it, write it off, move on. If you could identify anything like a customer relationship that is valuable, I don't know, an advertisement that is valuable, recognize that as an asset that is producing you something. If it's not an asset, you can't sell it, forget it, write it off. Anyway, my opinion. Their total assets, so I reduce it by current liability because current liabilities are always matched with the current assets. It's transitory, somebody pays their bill, the inventory builds up, so I kind of remove the current liabilities from like kind of the assets. Goodwill I also remove, look at the tangible assets only. I look at their total liabilities again, remove the current liability from there, so just look at like more of a long-term debt, that's more important to me. And then from equity, I remove goodwill because goodwill to me is something that is not sellable. I mean, if the company is doing well, goodwill is there. That's why we pay price-earnings ratios that are more than one, right? Like you're paying for the future earnings of the company. Goodwill is certainly there. But if something bad happens, and that's the reason anybody looks at the balance sheet. If something bad were to happen, how much debt do you have? How much equity do you have? Can you sell this stuff? Does the company deploy their capital well? In that risky scenario, goodwill goes out the door. It has to be written off and removed. So net equity. So Enbridge being in the asset-heavy capital pipeline business, obviously it's got a lot of debt, and their debt to equity ratio is growing over time, although it has been over 3, and they survived and they actually decreased it for a period of time, but now they're ramping up debt again lately, and I'll get to it why. So the company is barely making any money in terms of net income, and it's heavy in debt, already kind of a concern. They are paying though about 7.5% dividend. 7.5% dividend is huge, and the company is bragging about increasing their dividends. So this is the cash flow statement, the way I looked at it. Looking at dividends, it is a growing story, and that's what I loved about them. Every year your cash flow goes up by 15, 10, 30, again 11, 10%. That was wonderful. You're making more money than I could ever make off of my job in terms of salary increases. Like I wish my salary was going up by 14, 15% every year compounded, right? On top of the previous one, But in the last 3 years, they have not increased their dividend by more than 3%. So 2023, it's also another 3% increase. They're not even keeping up with inflation. Not so good. Their stock lately, kind of going back to this chart, their stock lately has not done anything either. So we're looking at 2022, 2023, they're stagnating. In the meanwhile, you look at S&P 500, actually not that phenomenal of a story. Enbridge is actually not too bad, comparably. Look at it. So everybody was down, Enbridge was kind of consistent. Well, anyway, I guess they survived through COVID handsomely. Look at it. If we go on the longer term, then wow, interesting. I didn't even check that type of range. But anyway, the dividends, when the dividend used to grow and the dividend yield was about 4.5%, it was exciting when interest rates were low. And now the dividend at 4.5%, 5%, given the interest rates are so high, is not exciting investors. So people sold off. The stock is not growing anymore, and it's just a whole different story. A whole different story with the higher interest environment. So I wanted to look at it even further. The way I look at a company, and I've covered this in my previous videos, make this bigger a little bit and more kind of more recent. So I look at their operating cash flows, that is growing, which is great. I look at their capital expenditures that are required to maintain and grow the portfolio. So there's sustainable capex, but there is also an investment in the future. And I don't differentiate between the two, because if you just expend the sustainable capital expenditures just to maintain your portfolio, well, you will shrink over time, because some of those assets are going to completely stop working. Some of those pipelines and I don't know, like oil and gas fields will no longer produce. Eventually, everything needs to be replaced. So sustainability, I don't buy it. Like, you have to, if you want to grow your dividend, you have to be investing, and that investment into the company for the future growth is already embedded in the stock expectations as well. So you have to be not just sustaining, but you have to be investing overall in the future. And I take the entire capital expenditures into here, as well as acquisitions that the company is required to make in order to grow that cash flow and grow that dividend. And if they don't do it, they're not going to grow, and then they become like a bond. They can't grow their dividends without growing their income. And why do I need a bond from Enbridge? I can just buy a bond from the government, let's say. Anyway, look at their dividends. Dividends are growing, 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 growing. They actually doubled it here in terms of the dollar spent. Why is that? Because they increased the number of shares. This is the number of shares. They keep on growing number of shares. So the story of Enbridge is that they make some cash, they invest it back in the growth, they spend it all, whatever is left goes into dividends. The dividends is a commitment, they're increasing it, they stand behind it, but it's not enough cash, not for acquisitions, not for capex. So how do you grow your capital? How do you grow your base if you don't have enough cash? Well, you either borrow, which is going back here into the balance sheet, either borrow, so their liabilities keep growing, or look at net liabilities. The net liabilities used to be 29 billion, now it's 96 billion almost, and probably keep growing. So they keep growing their liabilities, but then if your liabilities keep growing, you're gonna look too risky, and then you have to compensate by issuing some equity, so your debt to equity mix does not become too bad. And they keep on issuing shares, right? So they're in the empire building, really, company. They just build up their base. It's like me and you making jointly $200. The two of us are making $100 each. Then we say, well, we need to grow our business. Why don't we acquire one more piece of pipeline? But for that, let's bring some equity. So we bring our neighbor, and then we're making, instead of $200, we're making $300. Fantastic. We make $300 instead of 200, but now it's three of us. We divide the 300 by each. Each one of us is still making 100. So we're not better off by growing. We are a little bit better off in Enbridge, as in the dividend is still kind of chugging along. It used to be nicely, growing. Now it's no longer as nicely growing, but it's still kind of an increase, so it was okay. They did grow the size of the pie, but that became somewhat more increasingly complex in the last 3 years. Anyway, diluting the existing shareholders, issuing more debt, buying more assets, but overall each individual shareholder is not as much better off as the company makes it look by the size of their balance sheet. For example, they say, ooh, look at our assets, we've doubled over the last, I don't know, 6-7 years. Sure, they doubled, but their dividend didn't. Their share count diluted it all. So that's what they're doing. If I look at their price, I mean, it's been, 50, 57, now it's 53. I don't know why the trading view is showing us such a great return in terms of 100% and so on. Let me kill this. To me, they're not as exciting. Let's go back into the weekly and look at the actual asset price from, let's say, 10 years. 10 years-ish, Okay, so they did grow from, I don't know, 30, 25, 28 to 43. Not as spectacular, and most of it was very recent. If you look at this, like 2014 to 2022 and beyond, a little bit. Anyway, I'm digressing. So they do grow in bit of a share price. They do grow their dividend, but they diluting so much that it makes it less exciting. So that's the story of Enbridge, and I am somewhat confused whether I should continue keeping them or not. I mean, certainly Nasdaq makes way more in terms of the overall return. S&P 500 makes way more in terms of the overall return. Even the Canadian market, XIU, factoring in the dividends, the gap is not as big because Enbridge's dividends are nice. And they help the cash flow if you're dependent on it, because I love the cash flow in any portfolio. It allows you to reinvest. Should we continue investing it? It is nice and stable. I think the dividend is still stable and safe. 7.5%. I don't think they're gonna cut it. It's just like it does eat into their ability to acquire other assets, but they can still manage it. I mean, there's 7 billion out of 11 goes into distribution, whatever is left goes into the investments. They can get by, they don't have to cut it. It doesn't allow the company to grow as much. They did fix their dividends, not dividends, they did fix, like if you go here, you read some of these notes to financial statements, you could look at their debt, and they will fully disclose that their interest payments, first of all, they're stretched all the way to like 2083, which is crazy, 2052, so they have long-term debts. Some of them have maturities next year, but these ones are already at 8.2%, some of them, right? So their interest profile and the maturity is not going to make them sort of die, right? They don't have to cut their dividend. If we look back to some of these notes to financial statements, you would also see that their share capital is also a little bit misleading. They would say they have common shares, right? But they also have preferred shares. If you look at the common share count, it's here in the last 2 years. It didn't grow, but they have a ton of preferred shares. These shares have a fixed dividend payout. They stand behind the bondholders. They're technically equity, but it's still cash coming out of the pocket. So look at the dividend rate. These things are paying 4, 5, 5.5%. There's 19 or whatever the different series of preferred shares. Again, crazy amount to me, and that's about a quarter of all of their equity is in preferred shares. That also costs them cash. So cash position is a bit strapped. I suspect they're going to start increasing their share count again. So what I've thought about is maybe it's worth trading. So you collect the dividend and wait for the stock to go up. You can sell put options on it. You could maybe buy and sell covered calls. If you get called, wonderful, you made some money plus the premium plus the dividend. And at 7.5%, you are making good money while you wait. Also a point that at 7.5% dividend, it's almost like an interest rate play. If you believe that the interest rates are going to stop rising, maybe at the next meeting by the Fed, maybe 6 months from now, maybe a year from now. But if they stop rising and start cutting, then this dividend from Enbridge becomes more valuable. When interest rates go down, this dividend is more and more appealing, and the share price should go up to decrease that yield from 7.5 to 7.4, whatever it is, down to maybe again 4.5 or 5%, which will imply a nice rise in the share price. So it's kind of an interest rate play, it's a dividend play. It is not growing as much, but it's more stable. So if you want a conservative piece of your portfolio, this could be a candidate. So I'm not a huge fan of Enbridge. I wanted to get rid of it for so long, and every time I look at it, I'm like, well, but they're paying nicely. They're still kind of growing. there is still an opportunity maybe, and there's a spot in my portfolio, and I keep them, and I keep them, and I keep them, and I have been keeping them for a while, and I fully appreciate it. If I invested in Nasdaq, I would have made a ton more money according to those charts, and most of it would have been capital gains, and none of it is guaranteed. But also, Nasdaq is an ETF. There are lots of companies in it. You're not tied to management decision of one particular management team. You're also not tied to oil and natural gas. What if we all go electric? What if all the cars convert? I mean, a few years from now, who knows, right? There is a risk. With QQQ, Nasdaq, that risk is smaller. Technology is volatile, I get it, so is any other stock. So you kind of, it's a trade-off, and I am for now keeping my Enbridge, but I'd be curious to know what your plans are. Are you interested in cash flow? Do you see this as a risk? How do you perceive those high levels of debt, which will be refinanced at higher rates eventually, unless those rates plummet in the near future? So what are you thinking on Enbridge? I'd be really curious to know, because I'm looking into my pipelines overall. Next video I'll probably do on TransCanada. The next after that will probably be EPD, EDP, those enterprise partners. That's another pipeline. So I want to look at my pipelines and see if I want to keep them or when I want to trade them for, let's say, Nasdaq, because that thing is just going to hum and hum and hum, and you don't have that company risk. Anyways, thanks for listening to me analyze this stock. Much appreciate your time, and talk to you in the next week or so.